Imagine this, just a couple of years ago, Lululemon was the crown jewel of the athleisure world. People lined up outside their stores, their yoga pants became almost a status symbol, and the stock? It soared past $400 a share. Fast forward to today, and the picture looks very different. In 2025 alone, Lululemon's stock has crashed by more than 60%, now sitting around $170. That's a painful drop for investors and a shocking turnaround for a company once seen as unstoppable. So what exactly went wrong? And more importantly, is this a story of decline or a setup for one of the biggest comebacks in retail? Let's start with the numbers. In the latest quarter, Lululemon reported $2.53 billion in revenue, up about 7% compared to last year. Sounds decent, right? But here's the catch. Most of that growth came from overseas, especially in Asia. In their core market, the US, sales actually slipped, and comparable store sales went negative. That's a big red flag because the American shopper has always been Lululemon's foundation. Adding to the pressure, management had to cut their full-year outlook. Back in Q1, they were guiding for up to $11.3 billion in revenue. Now, they're saying more like $10.9 billion. That's basically flat growth, and for a brand used to double-digit increases, it feels like the wind has been knocked out of their sails. And then there are tariffs. Changes in US trade policy, like the removal of the de minimis import tax exemption, mean Lululemon will face an extra $240 million in costs this year. When you're already battling softer demand, that kind of margin hit stings. But maybe the bigger issue here isn't about macroeconomics or policy, it's about the product itself. Even management admitted that their pipeline had become predictable. In other words, customers aren't wowed anymore. That's dangerous for a brand built on excitement, exclusivity, and a cult-like following. Combine weaker demand with rising inventories, and suddenly the growth machine looks stalled. Now, you might be thinking, with all these challenges, is Lululemon still worth it? Surprisingly, I believe it is. Here's why. At today's valuation, Lululemon doesn't need blockbuster growth to justify its price. In fact, it only needs to grow about 1% a year. That's basically nothing for a company operating in a global athleisure market that's still expanding. If they manage to tap into that growth, even modestly, they could actually be undervalued by as much as 60%. Think about it this way. This is still a premium brand with strong global recognition, an established fan base, and a proven ability to expand into categories like menswear, footwear, and accessories. And while US shoppers may be pulling back right now, international demand is climbing. The fundamentals aren't broken, they're just bruised. So what's the key to a turnaround? Innovation. If Lululemon can launch fresh products that spark excitement again, clean up its inventory, and manage through these tariff headwinds, the stock has serious room to recover. In fact, I believe we've already hit bottom. With shares trading at a steep discount from their highs, the risk-reward balance looks attractive. That's why I'm calling this moment the picture-perfect turnaround play. Of course, nothing is guaranteed. Consumer spending could stay weak, inflation could bite deeper, and tariffs could drag longer than expected. But for long-term believers, Lululemon today may look a lot like Apple in its slump years. Underestimated, undervalued, and just waiting for the right spark to reignite growth. So, while headlines may scream about Lululemon's 60% drop, the bigger story might just be about its potential comeback. The brand isn't gone, it's just at a crossroads. And for patient investors, that crossroads might be the start of something big.